All right, so welcome again. Now we will see what is margin of safety and how we can calculate margin of safety. And what is margin of safety? As I mentioned before, margin of safety is a measure of amount by which the sales may decrease before a company suffers a loss. So that means what's the safety margin of the company? How far the company is safe from loss? Okay, so it is actually the difference between the actual sales, current sales, or budgeted sales amount from break-even sales. Before break-even is obviously it's loss. So where is the company now, and how far is the break-even point? How far the company is safe from loss? So it can be calculated in volume, in number of units, or it can be expressed in terms of percentage. What percentage of sales company is safe um, from loss? That means how if say for example if sales of the company reduced or decreased by 5%, then the company would be in loss. Or if the company's sales is reduced by 10%, then the company would be in loss. Or in number, if you can say, if the company's sales is reduced by 500 units, then the company would be in loss. So what's the safety margin of the company? That's the indicator or indicated by margin of safety. So next is margin of safety. You can see if you see in the graph, this is what the break-even point. And if you say you have X number of units you have sold or budgeted units is this, and what's the difference between the break-even and the X number of units? Okay, so this difference is being represented by margin of safety. Yeah, so how can we calculate margin of safety? Already mentioned before. So the budgeted sales or actual sales, okay, minus break-even sales level, okay, or the budgeted sales units minus break-even sales units, okay. Or if you want to calculate in terms of percentage, so what's the margin of safety that you have calculated here divided by budgeted sales units and represent that figure uh, by percentage. Calculate it into percentage, that is multiplied by 100. So in the given example that we have discussed before, the ABC mountain bikes, so we have calculated that 5,000 units is the break-even sales units, break-even sales. And the given budgeted sales were given in the question is 7,000 units. So 7,000 units minus 5,000 is 2,000 is the margin of safety units. So if you want to calculate this number or express margin of safety into percentage, then 2,000 is the margin of safety. Margin of safety divided by budgeted sales. So budgeted sales is 7,000 multiplied by 100. That is 28.6. So what does that mean? If the company's sales is decreased or fall down, reduced by 2,000 units, that is 28.6 percentage from the budgeted level, then the company would be in loss. So this is the safety margin. So 28% safety margin is not bad. It's not bad, it's good. Budgeted profit, if you want to calculate budgeted profit, so if you prepare an income statement based on 7,000 budgeted units level or product level, so sales revenue 7,000 times 12 is the sales price, so 84,000 sales revenue minus variable cost, so 7,000 times 3, that is 21,000 is the variable cost of the company. So if you deduct this from sales revenue, you'll get contribution 63,000 and fixed cost given in the question 45,000. So if you deduct fixed cost from contribution margin, you'll get 18,000 is the profit, that is budgeted profit of the company. All right. So if you want to prepare an income statement, or if you want to prove that your break-even calculation is right. So just prepare an income statement for 5,000 units level. So 5,000 times 12, then it will be 60,000, 5,000 times 3, that is 15,000. So it would be 45,000 contribution and fixed cost 45,000, and then profit would be 0. That means it is break-even point. 5,000 units is the break-even point. Budgeted profit. Yeah, we have shown 18,000 is the budgeted profit. All right, and this profit, so contribution profit margin of safety multiplied by contribution divided by units, or contribution per unit. Okay, so margin of safety is 2,000 multiplied by 9. Okay, is the budgeted profit. You can calculate the budgeted profit this way based on contribution. That is, for the extra additional contribution is your profit. So margin of safety is 2,000 units, and 2,000 units time contribution per unit, that is 18,000. Okay, and this 18,000 is the profit of the company, budgeted profit of the company. You can calculate in based on margin of safety as well. Budgeted profit, but what if the ABC mountain bikes know the profit we need and want to know the required sales? So if the company want to know how many units company need to sell to achieve a particular amount of profit. So in that case, what we can do is the total contribution, that is 45,000 plus 18,000 is 63,000, okay, divided by 9. That is the contribution per unit. The 7,000 units company need to sell to earn 18,000 profit. Okay, or you can calculate in other way as well. Okay, and for at that particular level, what's the sales amount required? Okay, you can calculate sales amount required as well. Okay, so is the 70 is the ratio. This is the ratio of there's the contribution margin ratio. 75% is the contribution margin. Okay, so how's this 7.75 came? So is the 9 what's called out of 9 out of 12. Okay, so this is 0.775. Okay, 0.75, 9 divided by 12. Yeah, so this is a contribution margin ratio. If you divide the total what's this called, total contribution by contribution margin ratio, you'll get the total sales amount. Okay, or you can calculate target profit amounts by, say, fixed cost plus target profit. All right, so fixed cost is 45,000 plus target profit is 18,000 divided by contribution per unit. It's the same thing, actually. It's the same thing. So fixed cost plus target profit divided by contribution per unit. How we can use break-even analysis. Break-even analysis, as I mentioned at the very beginning, the break-even analysis or cost volume profit analysis help us in making different decisions. Okay, so say what should, in case of setting the price of the product, we can use in case of determining the profit of the organization, in case of determining whether we should sell or not at a particular price. Okay, so different sorts of short-term decisions we can make based on break-even analysis, and also break-even analysis help us in case of forecasting and planning in future. Right, so if we have a target of achieving 20,000 profit or 100,000 profit, then how much we have to sell, all right, or what is the forecast of our sale in future. Okay, if our cost is this, if our sales price is this, then how many units we have to sell and how may we achieve that particular level, that help us, that break-even analysis help us to do. Allow various scenarios if what, to be tested out. Okay, different if what answer we can get. For example, if variable cost changes, what will happen to the profit? What will happen to the break-even point? What will happen to the margin of safety? We can analyze based on this analysis. If sales price changes, if sales price increase, if sales price decrease, if variable cost increase, if variable cost decrease, if fixed cost increase, if fixed cost decrease, what will happen? What will happen? All right. So in different scenarios, we can test or we can use break-even analysis. For example, someone can be concerned about increasing labor cost in future. So we may have an analysis. We can analyze, okay, if we sell this product and then we need to be anxious about the labor cost in future. So if we predict that labor cost may be increased by 10% or 20%, then what would be the impact of that variable cost increase on our profit amount? Okay, so obviously you can solve some problems in the seminar. These types of problem in the seminar. Analyze how changes in the output, selling price, cost will affect our profit level. This is just what I mentioned. So if volume increases or decreases, if sales increase, if sales decrease, if selling price increase or selling price decrease, or volume cost increase or cost decrease, how our profit amount, break-even amount, and also margin of safety amount will impact it. We can analyze those as well, and these are the facts that really important in case of running and making differences of decision regarding running business. As I mentioned before, I'll tell you some of the assumptions. So cost volume profit analysis is not beyond limitations, beyond assumptions. It has some assumptions as well. All variable cost will remain constant, right? So as I mentioned before, so the variable cost we will assume for a particular period will remain constant per unit. Variable cost per unit will remain constant, not the total. Variable cost total will changes, but all other variable remain constant. What are the variables? So the variable cost or the fixed cost or the sales price, sales mix will remain constant. A single product or the constant sales mix, okay, we assume that. All right, total cost and total revenue are linear function of output. Okay, so that is that is y equal to a plus bx. It's a linear function. Okay, it's not a quadratic or concave or convex line. It's a straight line. So the relationship between cost and revenue is a linear function. Profit are calculated on a variable costing basis. Okay, so profit is calculated based on variable costing basis. I think variable costing and absorption costing we have already discussed. So you know what is variable costing. So that means only variable cost is considered as the cost of goods sold. All right, and cost can be accurately divided between or into fixed and variable elements. As I mentioned before, we must know how much is the fixed cost and how much is the variable cost in the total cost of the organization, total cost of the product. We must know it. If we don't know, we would not be able to determine break-even point or margin of safety, or we would not be able to make any decision based on this tool. The analysis applies only to the relevant range. Okay, so the analysis will be within a particular range of activity. If the range of activity changes, our analysis will not be valid anymore. Okay, so for example, you have one machine and the machine's capacity the capability is 20,000 production level. So if you want to produce more than 20,000, then you have to increase your machinery. You have to install another machine. Your fixed cost will change. Okay, so in that case, and also your variable cost may change. Okay, so if the variable cost change, fixed cost change, in that case, no, our analysis will not be accurate. We would not be able to apply this tool in those situations. So the range of activity should remain fixed. And finally, the analysis applies only to a short-term horizon. Okay, so it's a short-term decision, particularly within a particular year, 1 year. within 1 year decision. What happens within 1 year? What would be the impact of the changes within a particular year? Okay, so these are the assumptions that we should bear in mind while using cost volume profit analysis or break-even analysis. It has some limitations. This CVP or cost volume profit analysis has some limitations. So what are the limitations? Accuracy depends upon the accuracy of data used. And this is for whatever the tools, whatever the techniques we use. If our data, if the material that we are using is not right, then the analysis and the outcome should not be accurate. So obviously, the result of the analysis mostly depend on the accuracy of the analysis depends on the accuracy of the data. Forecasting the future is difficult, especially in the long term. So as we mentioned previously, the cost volume profit analysis is mostly applied for short-term decision making. So we can't use cost volume profit analysis for long-term decision. It's actually difficult to do. Assume there is simple relationship between variable cost and sales relationship, as we mentioned before. So it's a limitation that the relationship between revenue and the cost is linear. Linear relationship is not concave or convex. Okay, so it's a simple relationship, simple equation. Sales income doesn't necessarily rise in a constant relationship to sales volume. All right, so sales income may not rise only because of constant relationship. Sales may impacted based on this, but this is not what we consider in case of CVP, or cost volume profit analysis. External constraints have to be recognized. Okay, so external constraint that need to be recognized. That's the part. That's the limitations of this analysis, that we can't consider the external constraints. If for any other reason, because of any other factors, if sales impacted, variable cost impacted, fixed cost impacted, that what we cannot predict, that we cannot control using cost volume profit analysis. And also it assumes the fixed cost remain constant over the volume range, okay, but fixed cost may change because of any kind of unforeseen reason, because of any unexpected reason, right? So fixed cost may changes, but we can't assume that, right? The limitation here is we will assume that the fixed cost will remain unchanged. It assumes the sales price doesn't change during the period. We assume fixed cost will remain unchanged. We assume the sales price will remain unchanged. We assume all units produced are sold. No inventory is being considered. No work in progress. Okay, in unfinished goods, incomplete goods. We don't assume that. We assume whatever we produce is being sold out. No stock, no inventory. It can only deal with one product at a time. There we can analyze for multi-product break-even analysis, but usually simply we use for single product at the moment. Okay, simple break-even analysis. So as the summary is, break-even point is where the total revenue and total cost is equal, where both line intersect each other. So that's the break-even point. And we can analyze break-even point in terms of using different graphically or numerically. All right, we can use equation, the ratios, the formulas, or you can use graph for determining break-even point. And obviously, as we mentioned before, it has some limitations, but break-even analysis is an important tool in the hands of the managers of the organization to make different sorts of day-to-day usual decisions of the organization. I'm giving you two kind of review question that you can practice. Let's see what the question says. Vans Shoes manufactures skateboard shoes for the youth market. Budget and standard cost detail for the next year include selling price $24, variable production cost 8.6, fixed production cost 650,000, fixed selling and administration, selling and distribution cost to 230,400, and commission 5% of selling price, and sales 90,000 units. Okay, so calculate the break-even point and calculate the percentage by which the budgeted sales can fall before the company begins to make a loss. That is margin of safety. Okay, so margin of safety. All right, so what is your fixed cost here? So variable cost per unit, selling price is 24, variable cost 8.6, and fixed production cost 650,000, fixed selling and distribution to 230,400. So you have to add 230,400 and 650,000. These two are the fixed cost, the total fixed cost of the organization. All right, and cost sales commission 5% of selling price. Okay, so 5% of selling price. 5% of selling price is how much? And this is also variable cost. Okay, sales commission is also variable cost. So 5% of 24. Okay, 5% of 24 is what is to be added with this. That would be your variable cost per unit. All right, so yeah, and now you should be able to solve it. Okay, so it is a little bit tricky. The factors are given in different way. So you have to include selling price, sales commission. Sales commission is 5% of 24, and this variable cost together. So this is the variable cost per unit, and 230,400 and 650,000. So these two together you will get total fixed cost. And then sales minus variable cost, you will get contribution per unit. Okay, not this one plus 5% of this, and then you will get contribution margin per unit, and then you should be able to find out break-even point. And also if you get break-even point, you should be able to find out margin of safety because you are given sales. Okay, selling price and sales is 90,000 units budgeted sales. So try it. And the next one is the marketing manager wants to raise selling price to 25 if the sales commission is increased to 8% of the selling price, and a further 10,000 is spent on advertising. Calculate the revised break-even point based on the marketing manager's suggestion. So considering the previous points, okay, so if this is an independent question again, so the marketing manager says you can increase the sales price. Sales price was 24. Now if you charge 25 sales price and sales commission is 8%, that is 8% of 25, and add with 8.6, that is your variable cost per unit, and 10,000 further if you spend on advertising, that is fixed cost. So your fixed cost increases, variable cost increases, and your sales price increases. If this is the case, then what would be your break-even point? Okay, right? So consider previous figures that you saw in the previous slide here. Okay, just the revised cost is sales price in the next case is 25, and variable cost is this one, this figure is right, this figure is right, and sales commission changes, okay, to 8%. So if this is the case, then what will happen to your break-even point only? Calculate that. All right, hope you should be fine, right? You'd be able to do it. And if you have any question, you can ask in the seminar on this, and also on the seminar questions. Thank you very much for watching. I hope everything is going fine. Thank you. Stay safe.